Det en episode vi la ut på Patreon nesten et år siden, tror jeg. Og nå publiserer vi den åpent i vår feed, som vi gjør hver gang vi legger ut en ny episode på Patreon. Så i dag la vi bak vår betalingsmur en spesialepisode med Peter, der han svarer på spørsmål fra lytterne. Men i dag, for deg, så kan du høre på det her intervjuet med Mark Dow. Det ganske fantastisk. Ja, du jobber selv om det helg. Nå har vi tatt opp en ny episode med en utrolig interessant person jeg har kjent i mange år, som heter Mark Dow, som har jobbet i IMF. Han har vært hedgefondforvalter, og han har tradet i veldig mange år sine egne penger. Han veldig morsom, og veldig åpen og aktiv på Twitter, og deler sine meninger og tanker om ting. Så i går kveld, etter mye om og men, så gjorde vi et opptak, og Peter, du som i Roma nå på Goldman Sachs-konferansen, jeg sendte deg akkurat et klipp, og du fikk høre det. Hva du synes?
Jo, altså jeg synes jo at, hva det norske ordet for refreshing?
Forfriskende.
Ja, det forfriskende fordi det jo, altså det forfriskende for meg fordi jeg tenker i makrotermer. Så sånn sett det forfriskende, og det selvfølgelig forfriskende bare høre noen gjennomgå dette fra et makrosyn. Fordi det også temaet her borte jo at micro is being crushed by macro i år. Og endelig så det på en måte makrofaktorene etter sånn over 10 år med kvantitative lettelser og sentralbankmanipulasjon. Nå foregår det fortsatt, bare så det sagt, til en viss grad. Og vi så et eksempel på det i denne uken. Men nå virker jo de makrofaktorene som egentlig de viktigste faktorene for økonomien, og altså for verdensøkonomien og også for nasjonaløkonomi. Nå virker disse igjen på markedene, og kan ikke ignoreres av. Altså, tenk deg hvis du kom til markedet for 10 år siden, så du har hatt en 10 år lang karriere som, da min karriere var 10 år gammel, så synes jeg at jeg var en veldig erfaren markedsaktør. Men for de som har de siste 10 årene nå, så har de jo på en måte ikke måttet bry seg om makro. Det har jo egentlig ikke vært et interesseområde engang, fordi det har ikke virket, mens nå virker makrokreftene, og det jo litt det Mark Dow inne på. Og han jo en autoritet, ikke sant? Han jo en gjenganger. Jeg høres litt sånn halvveis litt negativt ut, men det ikke det jeg mener med det. Jeg mener erfaren aktør selv. Og fra mange vinkler, som du nevnte jo bakgrunn fra IMF, og også fra makro-trading og så videre.
Jeg synes han brakte jo inn mange nye termer og innfallsvinkler som faktisk jeg opplever som helt nye. Og jeg vet ikke, for meg så var det veldig forfriskende å høre på, for jeg forventet på en måte kanskje å møte noe litt annerledes. Det lenge siden jeg snakket med han nå. Så det var enkelte ting som var virkelig tankevekkende, han sa, synes jeg.
Jeg enig i det tankevekkende. Jeg ikke enig i alt han sier, men jeg helt enig i at det tankevekkende. Og det jo nettopp, og igjen tilbake til det jeg snakket om med forfriskende, når noen har da for eksempel det motsatte eller et annet syn enn det man selv har, så når du oppfatter det som forfriskende, så det et veldig positivt tegn, tenker jeg, fordi da du villig til å stille spørsmål ved dine egne syn og teser. Og det bra, og det noe som alle burde gjøre, i stedet for å motta et annet syn, eller høre noen andre syn, og se det som fiendtlig eller kritisk, så gir det i stedet en anledning til å reflektere over noe som man kanskje ikke har reflektert over selv, og så kan det godt hende at man kommer til den samme konklusjonen man hadde i utgangspunktet, men da har man i det minste fått mer kunnskap ved å ha tenkt over og gjort sine undersøkelser om et annet syn eller en annen teori, og det i min verden ekstremt verdifullt.
Supert. Da tror jeg kanskje vi bare går i gang med intervjuet.
Det verdt å høre på.
Og så kommer du vel tilbake til Norge snart, så vi kan ta opp en vanlig episode også.
Vi kjører vanlig på mandag.
Supert.
Yeah.
So the issue with I've been trying to, when you have time to wait, you try to think about like clever questions. So I've been trying to think of like clever and punny questions to ask you.
No, there's
So
no need for that.
I apologize in advance.
No, it's quite all right. I mean, you just got to go with what you know, what's relevant, you know.
So I was figuring, like, because a lot of people follow you on Twitter, but people may not know about your experience. I was trying to say it as a question. Which part of your experience do you think best prepared you for 2022? Your time at the IMF, your time as a hedge fund manager, or your years as part of the Peanut Gallery and FinTwit?
Probably hedge fund, just learning how to manage risk. In an environment like this, it's the risk management.
Yeah.
You know.
Do you trade, or because it's so hard to pin you down?
Oh, I trade. I definitely trade. Well, it's also on my behavioral macro handle. So what, I don't know if I told you this, or you probably know this. I have a few years ago, I had this idea because I was getting so many followers that I was getting a lot of random guys saying stupid things and kind of clogging up my stream. So I kind of said to myself, I said, it'd be great is if I could have some kind of locked account where people could pay a small amount just to read the tweets and engage on these things. And that will filter out all the people who just want to talk shit, right? And if they do want to talk shit, well, at least they're paying me to talk shit, right? So I'll put up with it. But so I kind of set that up. Twitter didn't have a way to do it, so I kind of went with some programmers and whatever, and I set up this behavioral macro account. So over there, I'm more explicit on what I'm doing and just risk management schemes. I don't want to be always too explicit because then people brainlessly copy your trades and they might not be there to get out when you get out. You know what I mean? I might not be there to tell them to get out, because if you tell them to get in, then you're kind of on the hook to tell them when to get out. And it's and I want the key of the whole behavioral macro thing is to help these guys learn how to think for themselves, because everybody's going to have a different risk style, and the amount of risk we can sleep with at night is different for each one of us, right? And our personal situations, financial situations are also very different. Some people need to make money, people need to protect money, all that kind of stuff. So for those reasons, I don't like to be too explicit, but I share charts about my trade ideas. And then when people ask me, I say, well, I would look for a stop in this area, and the type of stop I would choose would be correlated to my position size in this way. And I kind of explain how to fish rather than saying, here's the fish.
I didn't know that. I remember you starting that now that you say it, and it just sort of flew by me. I don't know why I'm not following it, and as a paid follower.
I'm not really promoting it very much, but I have about like 400 followers or so.
Yeah.
And it's really small. A few journalists are on there too that we know from back in the day, way back when. But that's really it. It's a lot of young guys that want to learn mostly about risk management. I try and emphasize, de-emphasize ideas, though we talk about ideas, and emphasize the risk management, because the sooner these guys realize that if you want to be active in the markets, you're not going to survive unless you learn risk management, right? That's way more important than having the smartest ideas, right? Once they get that, then everything else gets easy.
How do you approach risk management? Is it in the similar way as people talk about how poker players think about the stack size? So when you lose,
there's a lot of overlap with that, particularly at certain points in time. You also have to think about your mental capital, right? You want to be in a position to bet big when you get the good cards, right? And even if you have a bit of a chip stack, if you just had a big drawdown, you might be a little bit more gun shy, right? You might be a little bit more reluctant to bet as aggressively as the cards suggest, or as the situation suggests you should. So I talk a lot about defending your mental capital, right? And how to sometimes little wins and things can turn around very quickly. You think, oh my gosh, I'm not seeing the ball very well, and then all of a sudden a couple things go right, and then you see it, right? So you have to learn how to adjust how hard to push it when you're seeing the ball and when you're not seeing the ball. that kind of thing. So I just help a lot of those guys. My basic thought, Severus, you want to develop if you're active, right, and you're trading and investing actively, you want to develop a style that relies as little as a risk management system that relies as little as possible on your batting average, your success rate with your pick, right? So that even if you're right 50% of the time, you're going to make money. And then if you're really, really good and you're right 62% of the time, then you're a superstar.
Yeah.
But if you work on building a system that minimizes as much as reasonable the need to be right, and you happen to be right, then that's a bonus.
Yeah.
But if you can learn to make money without being right, that's really that's the key.
The real issue, especially people running in this year and in the last few months, so it's been so incredibly easy for stupid people to make money. And that's like, generally, I always thought that was a red flag when stupid people get rich. It's concerning because it's difficult to be smart when everything goes the right way and with QE and all these sort of almost nonsensical ideas. But how do you and how do the people that listen to you approach these whipsaw markets? Because we're seeing this high volatility, we're seeing major down days, major up days. Like how do you play it? So how do you approach it?
It's interesting because like assets and asset classes behave differently. Some have, their day-to-day volatility is, let's say, 3%, but their intraday volatility is way higher. So the volatility of something is contingent upon the periodicity of the measurement. Are you looking at daily volatility annualized? Are you looking at 5-minute volatility, right? What kind of time frame are you looking on? So this maps to position size, right? Which goes to your question. If you're having a lot of intraday volatility, a lot of chop, as you referred to it, then you want to size your positions smaller. It's also true that in this part of the cycle, that it's not the time for making money, it's the time for keeping money, kind of thing. So err on the side of playing small, recognize that the game has changed, et cetera, et cetera. If you're aggressive and comfortable shorting, maybe now it's late to short, a little bit late, but that's been a useful tool as well. There's some situations where you say, okay, if the market continues to go down, treasuries have been selling off with stocks because whatever the reason. Usually when that happens, equities sell off to a point where people say, oh, this is really bad. And then bonds stop selling off and people start going into bonds as a flight to safety, right? So if you can recognize the points when that's starting to happen, you can buy bonds and have it be a hedge that probably works either way, right? So recognizing that point where you say, okay, the correlation is flipping. If I buy bonds here and stocks continue to go down, bonds are now going up. They're no longer going down. And obviously, if stocks go up, the pressure on selling bonds also declines and they go up, right? Because they're oversold. So those are the kind of things you try and.
Would you approach that as a lever trade? Like, would you lever?
I would if I needed to. Yeah, I mean,
to match the returns of stocks, but lower risk, right?
Yes. But one thing you do have to be careful about when you're using leverage in a long-short style is that when you're in a regime where the correlations can change quickly or the correlations are less stable. So you have kind of correlations sometimes like the one I was just talking about between stocks and bonds, where most of the times the correlation is one way, but sometimes the correlation is the other way, and you have to recognize what shifts you from one regime to the next. That's one thing, and that happens with a lot of assets, right?
Yeah.
So sometimes gold will correlate with stocks, sometimes it will correlate with rates, sometimes it will correlate with the dollar, and you kind of have to know which regime it's in and why, right? Now, there are other regimes where the volatility is just less stable, right? The correlations are just less, the correlation and the volatilities are just less stable. So if you're saying, I'm going to buy this, but I'm going to short this to protect myself in a regime where the correlations are less stable, then you better use smaller positions, because the probability of having a day where they both your long and your hedge go against you has increased. So you have to have small positions to be able to hold on to them. So there are two things. One is the height of the correlation, the strength of the correlation, right, and its regime shifting characteristics, and the other is the volatility of the stability of the correlation. And we're in a regime right now where the correlations are fairly unstable, even if they're high across a lot of assets.
There's one factor that's been correlating very, very accurately. Inverse Kramer.
I know people love to say that, but I think Kramer gets too much heat. I know he's an entertainer and he says crazy things, but I find him useful as I've been watching him so many years. I find him useful as a read to what the markets are doing, and sometimes he does have good insights. As much as because we can all find a tweet where he said something just before the opposite happened. It's just too easy because the frequency of his pronouncements, right? But I think because of that, we probably give him less credit than. I mean, there's a lot of things you can criticize about Kramer. I'm not, but I think we're too harsh on him. I guess is what I'm trying to say. The poor guy. Well, I guess poor guy.
I love it. You're contrarian Kramer. That's amazing.
Yeah, well,
that's almost the first time I've ever heard that.
I have some things I can say about Kramer that have made me unhappy, but where I think he hasn't been right, or I think he's been sloppy, or I think he's done damage saying things that he shouldn't have been saying. And not just about stocks, about people and things like that. He can be really judgmental and superficial, and doesn't always, consider the weight of his words. But on his stock picks, I think he does have a good feel for the market a lot of times. So it's worth listening to, and you just kind of have to know what to filter.
It's a good signal, I think. But depending on, like every signal, it's complicated.
Well, even more than the signal, Sverre, the way I look at him, I listen to the narratives that he uses to explain what's going on or what might go on. And I say, okay, do these narratives make sense? How many people believe in these narratives? Are these narratives in the ascendant or the descendant, right? So that I use him. He explained, like a lot of people who come on TV, they try and explain what the market is doing, and they have their theories. And I pick and choose from those and say, okay, what makes sense to me? And I go, okay, well, if that's true, then these correlations should be doing this. And then I kind of test them. So I find it useful to hear the narratives that he puts forward, because sometimes they make me think, and I say, hey, that makes sense, or maybe that is going on. Let me check this. And you want to know what the narratives are that are running through the market, whether you think they're right or not, right? You need to know them, and you need to know whether they're strengthening or weakening and what influences them. Like, right now, looking at the markets, we know if oil and copper continue to go down, that's going to take a lot of pressure off the Fed, right? Because that's the price of oil. The price of oil. I mean, if you decompose the inflation problem in the United States, right, lately, you'll see that gasoline is up 70%, 75% since the first signs of Russia invading Ukraine. Oil is up probably 60%, right? And just as if you go back into March, you can see a lot of the other prices associated with trucking or used cars or whatever, they were starting to come down. But the upshot in oil was so powerful that it masked all these other factors, right? And that kind of freaked a lot of people out. So now the Fed has come out, and we saw last week, they said, listen, we didn't cause this inflation that much. I mean, a lot of this is just oil, something we can't do that much about, right? And you look at the numbers, that's how it is. But our mandate is inflation, and the absolute number of 8% is just too high. And we're gonna start ratcheting. We're gonna raise rates until inflation comes down one way or the other, and whether or not we're responsible, whether this is something that we can control. Because the Fed is getting criticized from the one side from having waited too long and letting inflation get so far out ahead. It's getting criticized by others, not that many, but some, by saying, why are they raising rates and to kill the economy when this is really about oil at this point? Everything else is starting to turn over. They run the risk of killing the economy. And I think the Fed is going to try and thread that needle with the word nimble.
Okay, can we stay on that issue you just said, because your IMF background, I don't remember exactly where you were. Was it South America you were dealing with? I don't.
No, everywhere. I went to South America. I went to Asia. I went to Africa. I went to Europe. I went all over the world.
But you saw inflation, I'm sure, in a lot of these places.
Oh, yeah, I remember there was one time in Angola where we went to the money changer, and basically he put stacks of the name of the currency is Kwanzaa. They had stacks of Kwanzaa. You say, okay, here's $10, and they would just stack them up the approximate height of the stack. They didn't even count them, right? Yeah, so they had inflation.
That's like casino when they're weighing money.
Basically, yeah. And I think I helped them. I helped them build the methodology for calculating inflation there, and I think it ended up being 210% or something like that.
But then it's perfect to ask you, because something I've kind of been annoyed by in this whole inflation debate, and I'm listening to the press conference yesterday and or on Wednesday, and it's like this frustration because everything's like, no, that's not caused by us, this is caused by someone else. And my point of view is it doesn't really matter where inflation comes from. Inflation is inflation. It's not in a vacuum. So it's been so long since we had inflation in the West. So I think we kind of forgot it. Like in the 70s, it was a lot of external factors that had little or nothing to do with central banks or money printing or anything. It just kind of happens.
But not back then. There was a lot of money printing to finance the war in Vietnam and things like that. It was also new that we no longer had a currency linked to gold, right? So there were free floating currencies. So a lot of things were different. There were also wage and price rigidities. Remember, they had price controls, and you could buy gasoline on alternate days, and and unions were much more powerful. So there were a lot of structural differences.
But can I just finish the argument and the question?
Sure.
Because I've never had the ability to ask anyone this. I've just been thinking about it. And so my idea is, like, you think of a whack-a-mole or something like that, where you press down one place and it just pops up somewhere else. Yeah. And if you look at, like, in 2008, you had all this money pouring into the system from different directions, and it popped up in Iceland, of all places, or it popped up in some football club that's all of a sudden buying players for $1 billion. And so my point is, like, I wonder if we don't fully understand inflation. And yes, we get this fueled inflation now, but I think that it has to be linked in one way or another with the previous 12, 13 years of experiments. Don't you think so?
So I don't agree at all with this. I think for a couple of reasons. So let's go back to Iceland for a second, and the football teams and all that crazy stuff. Where was the money being poured in from in 2008? Where was that money coming from?
The UK? No, I don't remember.
It was coming from the private sector. It wasn't coming from government. It wasn't coming from central banks. What was the interest rate? What was the Fed funds rate in 2008?
Was it 6 or 4% or something?
Exactly, 5%, 5.25%, something like that. So what I'm saying is, money is created by the private sector. The bulk of the money supply comes from the private sector. So if I lend you money against my services, let's say I sell you consulting services, right? And you give me a piece of paper for $1,000 saying I owe you $1,000, right? That's, in a sense, we've just generated GDP, economic activity with no money printing, no need for anything like that, right? And then if I take that script, if I take that note, the IOU that you sent me, right, gave me, and I take it to your family, and they trust you very much. So I say, I will sell this to you for $998. It's worth $1,000. They go, oh yeah, well, he's good credit. I can trust him to repay, so I'll buy it from you. Well, then we just created money, right? So people have this idea that money can only be created by central banks pouring money into the system. That's not how it works. That's a very small part of the money base. Money is created endogenously is the word, right? And that is by our activities. So there was a period, if you go back to one of a post I wrote a long time ago trying to clarify this, there was a period there from, like, when was it? I don't know. It was like a 20-year period where credit went from 1 trillion to 8 trillion, and credit to the private sector, bank credit, went from 1 trillion to 8 trillion. And the reserves at the central bank, that is the money printing, the balance sheet, actually declined by a couple of billion. So all that lending took place with absolutely zero change in reserves. It's not needed. What it's needed for is to ensure that the banks have enough liquidity amongst themselves to settle payments, right? That's all it's really needed for. If they need to settle payments, they can, because they can't take Fed funds and pay anybody with it except other banks. That's all they can do, right? Because it's a deposit trapped in the federal funds system, right? So this whole idea that they're pouring money in, so Iceland's a great example. That happened with interest rates at 5% without governments pouring money into the system. And think about this. Let's go back. You're younger than I am for sure, but go back to 2000 and 1999 when we had the dot-com bubble, right? Where were policy rates back then? 5%. But yet we had the biggest bubble that we ever had. So, and then also look at 2010 and 2008 and 2011. There was no credit extension whatsoever, and we were doing massive QE with zero interest rates. Nobody was lending or borrowing. So what I'm trying to say, I'm not trying to say rates don't matter. I'm saying there are other factors that matter more. There are many periods that we can show where the rates were really low and no one wanted to borrow or lend. And besides, who wants to lend at a lower rate anyway, right? Why does everyone says, oh yeah, well, lower rates means more borrowing because everybody wants to borrow at a lower rate, but who wants to lend? Why would someone lend at a lower rate or at a lower spread? Why? Because he's greedier. He wants to take more, his risk appetite is higher. And that's the big equation, right? That's the big variable. Yes, interest rates matter, but many periods in history where interest rates were zero and people weren't lending or borrowing, and many periods in history where rates were 5% or so and people were borrowing and lending like crazy.
Thinking back to 2013, 2015,
yeah,
I just remember that feeling in the economy where anything was possible. And I was traversing a little bit into the startup space, and I saw everyone talking about the possibilities. We're a few years into the iPhone age, and there were all these fortunes being made. This was pre-crypto in many ways, and but the feeling in the economy was just optimistic, like anything could be done, but it wasn't manic. It's interesting, your approach.
But that's how it starts. After a crisis, everyone is risk averse because the memories and the scars from the crisis are just too fresh. And then, so even though rates are zero, right, and there may be QE, everyone goes, well, maybe I'll buy some bonds, but I'm certainly not buying stocks. They're way too risky. I had a really funny tweet about that where it said something like, 2008, they said, oh my God, we've lost a whole generation for investing. We're never going to make money again. And then 2013, it said something like, well, if you buy an asset allocation product, if you index, at least you'll make some money, right? And then all of a sudden by 2019, they're going, well, if you pick like the best stocks, then you can outperform. And then you fast forward to 2021, and people are saying, I'm investing in a picture of a rock, right? That's how the risk taking progressed. It starts from I don't want anything to do with the risk. Well, maybe a little, and then you know what? A little risk is fine. And then
I seen you try to sell that rock on Twitter.
Exactly. And then I'm investing in a picture of a rock. It's where we ended up in 2000.
It would be so funny if that was legit. Like you actually tried to sell an NFT, being the biggest crypto critic I've ever seen.
That would be funny.
But you're rebuilding sort of my view of the economy in real time here. That's a very interesting take you're having, and it's genuinely different.
Yeah, well, it's the way things work. I've lived through enough cycles to see it. There's that old saying I used a lot from J.P. Morgan, the old banker, right, from way back when, the guy whose name was given to the bank, basically. And he was famous in 1907. He got all the bankers together since there was no central bank, right? That was the intellectual basis for putting together a Federal Reserve, so that the banks didn't have to agree to do that. But his saying was, and I think this explains risk-taking much more than interest rates, high or low. He said, nothing so undermines a man's good financial judgment as seeing his neighbor get rich. So that's what happens. We come out of a crisis and we're super risk averse, and then we start to see people doing okay. Our job feels a little bit more secure, and we say, maybe I'll take a little bit more risk. And then you see others around you taking a little bit more risk, and then you feel better, and pretty soon you feel good. Everybody's making money, but you're not going crazy yet. And then in a few years, everybody's going crazy. It took longer in this cycle because the depths of the scars from 2008 were so much greater, right? But that's the mental process. And the guy, Minsky is the guy who wrote about it, the Minsky hypothesis, where he said stability breeds instability, right? So I think that really explains it, and that's why this whole notion of inflation. It's because they're pumping money into the system. It's just a perception. It really doesn't work quite that way. And it does matter what kind of inflation you're having, because everyone says, "Oh, core inflation or not core inflation." But think about it. If you're a doctor and a patient comes to you with a fever, you want to know if it's viral or if it's bacterial. It doesn't mean that the patient's not suffering. You just want to know what it is. You can you want to diagnose it properly so that you can address it. Same thing with inflation. You look at the type of inflation it is, because that will dictate what kind of tool you want to use. In this particular case, with oil, the Fed can lower the price. Can lower the price of oil, but they have to kill demand to do it. The Fed can't make more barrels of oil. They can't do that, right? So if the inflation is the kind that's coming from excess demand from wage growth, then the Fed is better suited to address it. But if it's coming from supply side shocks, a series of them, then they really can't address it as well. However, most people don't see it that way, because they don't have the tools to look below the surface. They just say inflation is high, I hate it, you got to do something. And the Fed said, okay, at 8%, we got to do it, even if this is coming primarily from oil and gas. We've got to start, because there are elements now, other elements that, because we've had so many supply side shocks, we've had high inflation for a while, it's starting to bleed into other categories and alter expectations. And that's why the Fed stepped in on Wednesday and said, okay, it's starting to affect people's expectations about where inflation is going to be in 5 years, and that we can't have, even if we don't have a lot of control over the price. So they wanted to send a signal.
This is so interesting. It is literally a new approach that I've never quite heard said this way. Can you see the chat window? I sent you an image.
Yes, it popped up. Where is it? Where did it go? What was it an image of?
It's our logo that I made.
Oh, very cool.
Do you recognize it? If you can see it.
It's a graph of, not sure.
What? It's that bubble. The bubble chart, if you remember, the one that follows the cycles of a bubble, and I sort of stylized it, and what you're describing is something that I've always thought was the case, that really what markets are is just collective psychology, which is why this graph exists, because you look 300 years back, you see this graph. You look at ARK, you see this graph. You look at Tesla, you look at Bitcoin, you see the same graph.
100%.
So that's interesting. But do you have a sort of an alternate version of this? Because by your...
In my head, I do. Yes, I understand the process works that way. Yes, through these psychological phases. That's exactly right. And where you are in those psychological phases is way more important than the price of money. And we can test that out. Right? Like I said, we can look at 2010 and 11 and 9, and no one was borrowing, and rates were zero, and we had massive QE. And then you look at the other periods where there was no QE and rates were 5%, and we had massive bubbles.
You don't think that the price of money matters?
No. I said earlier it matters. It doesn't matter as much, or if it mattered as much as these other factors, we would have seen lending in 2010 because the price was zero. Right? We wouldn't have seen lending and borrowing in the bubbles of 2000 and 2008 or 2007 because rates would have been too high. The investment banks got into trouble being 33 times levered when the Fed funds rate was at 5%, right? That doesn't square with the people who think that all bubbles are caused by the Federal Reserve. The problem is, Fair, it's so intuitively compelling to say, oh, the Fed's printing money, even though they're not printing money. People use that phrase. And they go, they're pumping money into the system. Of course we have inflation. It's just too simple, too intuitively compelling, but it's wrong, right? That's not what's happening. The fiscal policy of the United States had more of an impact on inflation than the monetary. Because that money, you can lead a horse to, the old saying, you can lead a horse to water, but you can't make it drink. Have you heard that expression?
Yes.
Well, you can lead a bank to liquidity, but you can't make it lend, right? And whereas fiscal, when you do fiscal policy, you're putting money in, you're injecting it into people's budgets, right? When you're saying, I'm going to lower the interest rate, you guys decide if you want to borrow or lend, right? That's a different thing. So if you're risk averse, you're not going to lend or you're not going to borrow. But if you're risk averse and the government gives you a big fiscal transfer, you're going to spend some of it. That's why fiscal policy has been more powerful.
So what we need now is sort of a Federal Reserve of cheerleaders. So basically, we need an army of Jim Cramers.
In what sense?
No, but I'm not being facetious. I'm serious. Like, if psychology is really the key factor, is a bigger factor, the way to stabilize prices would be to stabilize psychology. No?
I mean, we have a material shortage in oil and some other things because the production, two things. Production dropped significantly when COVID hit, right? You can see it on all the charts. And this happened for home builders, this happened for retailers, this happened for everybody. Everyone said, oh shit, the economy is going to collapse. I need to cut back production. And they cut back too aggressively because they didn't anticipate that the government was going to be so forceful in supporting people's incomes and jobs, right? So the government was kind of filling in the hole of aggregate demand that COVID shock gave us. Now, you could argue they filled it up a little bit too much or not quite enough, and that will depend from country to country. But that's basically that's basically what happened. And inflation obviously would have been a lot lower if they didn't do that, but we also would have had unemployment at 9% or wherever, right? So it's a bit of a trade-off. But fiscal does have an impact on inflation in a way monetary may or may not. Doesn't matter. Monetary can if our psychology is right. But if we have these shortfalls in oil that are material, psychology can't fix that. Right, it's just going to take time for us to get our production level. I mean, of course, Russia was the second factor, right? So production was hit across the board with COVID, and then in the oil sector, Russia, we were hit by the Russia thing too. Monetary policy is not really going to fix that.
You are probably the most vocal crypto critic that I see.
I have fun with
it. You really do. Why do you love to hate it so much?
Oh, just because I think it's a fake asset. I think it's the emperor's new clothes. People were fishing around based on bad monetary thinking, right? We need to protect ourselves from bailouts and money printing and all these other things that they didn't really understand, right? That's how crypto kind of started. And after the last crisis, there were a lot of really bad stories about the bailouts and cynical conspiracy theories and what was done, what wasn't done, and the effect of printing money. Remember, people were looking for inflation for 10 years and it didn't happen, right? It only happened when we had all these supply side problems and powerful fiscal stimulus, right? That's when we got the inflation, not before. So there are a lot of people kind of in that camp that were looking for inflation for the past 10 years, and they say, oh, Bitcoin will protect us from this. And it started out as a permissionless way. We don't have to deal with you, a US dollar. We've got Bitcoin now, and we can do permissionless transactions, and you can't stop us. That's how it started. Well, it didn't really work very well for currencies. And then they said, well, it's a store of value, right? And, it was going up in price. So, of course, it's a store of value, although that's not really what a store of value means. And then it was an inflation hedge. And then it was a hedge against bear markets or systemic sell-offs and all that. And they kept changing what its use case was, right? And it never worked. And in the investment world, when people start changing their investment thesis randomly like that, that's a sign that their initial thesis wasn't good. And we've seen that with Bitcoin. It's always they give you some word salad about technology and promise you, but we're building this and decentralized and reconfigured, blah, blah, blah. It sounds really great and it's coming soon, but nothing ever happens, right? Nothing.
Did you see the Mark Andreessen podcast interview? When he tried to give a use case for Web3.
It happened to another guy too, another guy who's more sympathetic.
Yeah,
Patty somebody or other who writes a lot about Web3. He got caught in the exact same situation, right? Because there's nothing there. There's nothing there. So that's why, and I think because behind Bitcoin, there's a whole universe of hype men who are promoting Bitcoin on the back of propagation of really bad and paranoid monetary thinking, right?
Well, Zero Hedge and Bitcoin was launched virtually on the same day.
Doesn't surprise me, right? It's the same kind of sentiment, that nihilist, everything's going to hell. And I think though they're misinformed, they still people are getting dragged into Bitcoin because they're looking for transformational wealth quickly. Why? Because we're late in the risk cycle, right? The one we're talking about earlier. That's what's really going on. But they fall under the spell of all these alternative explanations, conspiracy theory, monetary policy kind of things, because they want to be long Bitcoin because they think they can make transformational wealth. That's really it. But in the meantime, they're buying into these bullshit ideas that make them more cynical than they should be about our institutions. And I know from my travel of the world, or travels around the world to all these different countries, what separates us in the developed economies, and particularly in the US, from all these other countries is the quality of our institutions. The fact that you can trust property rights, the fact that, all these kinds of things. So when I see Bitcoin eroding this confidence in our institution based on lies and misunderstandings and conspiracy theories, I think it's not just a shitty asset. It's bad for society. It's also attracted a lot of people, smart guys from the labor force. They wanted to all work in Bitcoin because they can make money quickly. This happens, again, late in every bubble, right? And it detracts a lot of brain power from other areas where we could actually use it, because there are a lot of smart guys in crypto that kind of fell under the spell.
You had this beautiful phrase when we talked before this, when I asked you what you thought about Elon Musk and the Twitter attempted purchase, and potentially now he's stuck with this incredibly expensive asset that he can't get rid of.
Yeah.
And you had this beautiful phrase that you called it.
Yeah, late cycle hubris. This is a guy who's a bit of a tyrant in his business, right? He's a bit of an autocrat in his business. And he's used to getting what he wants. And as he's become more famous and wealthier, fewer people are going to stand up to him. And those guys start to develop a warped sense of reality, I think, sometimes. I mean, he's done some amazing things with SpaceX, just amazing. And Tesla, he basically launched the whole EV industry. He gave it a big push, right? And that's all to the good. But he kind of acts like he's above the rules and doesn't think laws should apply to him. And that's never good. And I've seen him pick on people, be a bully, like with journalists and things, to discredit them, saying false things about them, right? And he also he used Twitter very artfully to get through periods where Tesla almost didn't make it because of the funding, right? Now he had to lie. He had to say the funding secured 420 to scare out the shorts when he was under a lot of pressure, and he said a lot of other things that. I sent a tweet a few months ago that said, when he took over Twitter, promising an edit button by 2019. He was always all these things that he promised back in 2015 and 17, they've already passed and haven't happened. So he was kind of a fake it till you make it kind of guy, but he's made it, right? So I don't have a lot of respect for him as a person, the way he carries himself, but I have a lot of respect for his achievements. I think he's done some pretty incredible things business-wise. So I have, like everything, mixed feelings. It's not all good or all bad.
Kathy Wood.
Yeah, she comes across as a religious zealot. That's what she comes across as. So I don't know what to make. She had an extremely compelling narrative when prices were going up, because prices were going up, one, and two, the future, technology, bet on it. Look at all these wonderful companies happening, and technology and Bitcoin and this and that. And yeah, technology wins, but how that maps to equity performance is another story. So I find her as a religious zealot, with a very compelling story that we want to believe in, right? We want to believe technology is going to be transformational. So it's an amazing pitch. And then she got caught lightning in a bottle when Tesla started going up, and it was her largest position, I think. And she had a position in Bitcoin, and these were both going up a lot. And then when your fund goes up a lot, guess what happens? Everybody wants to buy it. They're chasing returns. One of my friends, it was like at 115 or something like that, and he goes, well, let's just, I help him with his portfolio. And he said, let me just buy some and just sit here for the long term. And I go, dude, you don't even want to touch this thing right now. It's just too hot. You got to wait for it to calm down. And I had a hard time talking him off the ledge from buying it. Ultimately, he didn't buy it, but he would have gotten trashed. And there were a lot of people thinking that way. All these new companies were coming out. Well, look at this as a battery. This is a really cool idea. Let's just put X thousand in that, a small amount, and see what happens and forget about it, right? And a lot of guys had that mentality, a year ago, 18 months ago, and they've really gotten hurt.
What do you think about the 4 central bank shocks we had this week? You had the Fed, ECB, SMB, and BOJ all going in sort of different directions.
Yeah, I think they were saying, okay, guys, the absolute numbers in inflation are getting pretty high. We got to do something. Even if we can't address it concretely. So that's it. And there, to some degree, when the U.S. is getting ready to go, others have to go too, because the dollar's been really strong. And, with that Fed move on Friday, it kind of made that differential even greater, right? However, if to the extent that oils, and this is why I was saying what I was saying earlier, to the extent that oil prices and copper prices come down, it takes pressure off of the Fed to need to ease, and that puts less pressure on these other countries to need to hike, right? To keep their currencies kind of in line, or just,
Speaking of your crude comments, which is super interesting, and I think you're probably spot on. Today we had this really weird sell-off in oil, weird in my eyes anyway, and I'm thinking like, based on your assessment now, so it's a 2-part question. One, do you think it's possible that this is caused by something akin to the plunge protection team? And number 2,
I made that
do you
joke.
think plunge protection actually exists?
No, plunge protection does not exist. It's not a thought. I know it doesn't exist. Right? It's one of those speculation, those conspiracy theories that the guys in the futures pits in Chicago would talk about when they didn't want to, because you're always max bearish at the lows, right? That's just how, and you're max bullish at the highs. That's just how it works. So yeah, when it reverses on you, a lot of people by definition are going to get caught out. And rather than saying, oh shit, I overstayed my welcome, I got caught out, they go, goddamn government screwed me. We all know, look how bearish everything is. Of course it was going to go down. There's no way that price action was just phony. I could tell you it was phony. I've been working in this pit for 20 years, these pits for 20 years. I know phony price action when I saw it. It was, and then everyone would rather believe I got screwed than I screwed up.
Yeah.
So that's kind of how these things get propagated. I made the joke earlier just to try and get the conspiracy theorists all excited. But no, it's not that. Now, it may well be that there's a policy initiative where they're going to Saudi Arabia or whatever, but I think the most likely scenario explanation for the sharp decline in oil in recent days is bear markets eventually come for every single sector, right? And the sectors, right, and the sectors that were last to go were ones where you're making money and ones that are, we call them widows and orphan stocks, the last things you want to sell, like Apple, right? Those are the last things you want to sell.
Yeah.
So I've been saying the places you want to short for the past few weeks. The places you want to short are these mega cap stocks like Apple and Microsoft, because those are the last things people sell. Meme stocks, which are still overvalued, and the faith-based assets like Bitcoin and gold, right?
Yeah.
That people they're still hiding in because they think it's going to help them from something, but they're increasingly realizing, hey, it didn't really help me at all, right? So they're forced to get out.
So the big question people ask,
and then oil, and then the final sector is oil, where there's still a lot of profit. So that's where the selling needs to be now, and that's kind of where it's happening. It's been happening.
So Apple is down 27%, Tesla is down 40%, Amazon is down 38%. This is yesterday. Google is down 25%, Exxon is up 48%, Netflix is down 71%.
Yeah.
Just some big assets that I looked at.
Right.
And everyone is saying, is this the bottom? Is this the bottom? Is this the bottom? And I heard many people use this analogy saying, yeah, when Apple is down 20%, you can start buying. And now it's down 27%. And I'm wondering, like, a lot of pain has been taken out of the markets.
I think so. So to finish that last thought, oil is being sold off because it's kind of the last pocket of profits to go after. The bear market is finally going. So that means we're close to the end, right? To get back to your question, but I don't think it's anything fundamental about the oil market. Any market that has done as well for as long as the oil market has, it's been going up phenomenally for a year and a half now, right? That's going to attract momentum, and it's going to attract leverage. And that, I think, is what we're seeing unwind right now. That's it. I think it's really just that, that whole psychological thing. I think that's really all it is. But I was leading back into another question. So oil is going down for that reason, but you were asking, is this the bottom? We're pretty close, but I'm kind of obsessing about us needing to see the VIX at like 40 or 45 one day, where we finally get that last capitulate. We've had a lot of heavy selling the past week or two, but we haven't had the full-on panic. We had maybe
the fear is not there. I don't see the fear yet. I see more fear.
Yesterday, there was a little bit yesterday, but not as much as we often do. And it may be that there's structural changes, as some people argue in the markets, that make it so we're not going to get that kind of spike in volatility or volume. I tend to be skeptical, and that's why I'm kind of obsessing. That keeps me from getting more bullish. Right now, I think we bounce. I covered all my shorts. They're all covered. As of yesterday, I'm starting to get long, and I'm hoping to get longer. But I'm not sure if this VIX 45 thing is going to keep me from being able to get longer, or the market's going to go up and I can add to my risk. I don't know. But we've seen.
But Tesla's PE is still 87.
I don't think the PEs help too much in this particular case. I mean, in some respects, yeah. If you get a PEG ratio that's below 1 in like Apple and Microsoft, we probably come far enough. The PEG ratio is the price to earnings divided by the growth rate. And if that number is less than 1, so let's say Apple's got a PE of 20 and it's growing at 10%, then it's got a 0.5. No, it's got a 2. It's got a PEG ratio of 2, and that's not good. If it's growing at 20% and has a PE of 10, then it's got a PEG ratio of 0.5, and that's really good. So there is probably on valuations an ultimate bottom in some of these assets that people look for. But as a general proposition, people are just selling until they de-risk sufficiently to feel like they're safe. Right, and it's really, and the question is, how far along in that process are we? And as I said earlier, because we're selling the oils now, and because we're selling the widows and orphan stocks, and because the memes and the faith-based assets have been really beaten up, I think we're pretty darn close.
Wow, I think that's a lovely optimistic sentiment to end on.
Well, no, it doesn't mean that things get better, but necessarily. But markets can get better with the economy still having problems.
Oh yeah, the economy is this will cycle through the economy, of course. What do you think about housing in this relation, which is so overpriced compared to income and these things?
Yeah, well, it's not crazy. I mean, in the sense, it's just changed a lot, but it was really cheap because interest rates were so low, right? So even with the high prices, the monthly payment wasn't that bad because interest rates were so low. Now that's changing, obviously. Yeah. What's protecting, and this is the big debate, what's protecting the housing sector is that after the big financial crisis where housing was central, the home builders were scared for a decade and were underproducing. Right around the time the millennials were coming into the labor force in full strength. Right into kind of those years where their household formation is the way they call it in the statistics. So there's a backlog of demand, even if housing prices are now expensive because interest rates have gone up. And the question is there going to be enough of a slowdown to offset that backlog? Or is it just going to offset that backlog, right? So it's a bit of I think the underlying, people are a bit conditioned to fear housing because of what we went through last time. I think this is a very different situation. We have too few houses is a much bigger factor than the demand or Fed policy or all these other kinds. We just underbuilt for a long time. My guess what's going to happen is prices are going to start coming down, inflation is going to start coming down, and people are going to say, okay, the Fed is going to be able to ease off as soon as it sees the economy start to slow meaningfully. And then people say, okay, then we know that yields aren't probably going to go much higher than this. And once that uncertainty of how high they could go is reduced, then they can kind of settle in and people can figure out if they want to buy a house or not. But right now, with everything in motion, no one's going to want to, they're not going to want to try. They're going to want to believe that they know that there's a cap on the interest rates. That we're not going to go much further. So I think that's how it plays out. But it might take a minute or two.
You have a very complete theory, incredibly convincing argument.
I mean, I don't know if I'm right, but I'm always internally consistent. I've thought these things through from different angles, and it has to make sense to me from different angles, or it doesn't hold together, right? So it's maybe not always right, but I'm definitely internally consistent.
It's a very coherent theory, and it's based on personal experience, I guess.
Yeah, I know, being old and having been through a lot of markets, right? But that's kind of how you form these things, and then you kind of feel your way through based on your experience. But
in a way, we're kind of the saving grace is that the stability of the banks now, because of all this aftershock of the financial crisis.
Yes, thank God for the bailouts, right? Because the bailouts, I mean, first of all, the taxpayer here made money, and second, the private sector paid for the recapitalization of the banks, right? Because after they rolled out that plan, the TARP plan, the stress test, the Treasury Department and the Fed sat the banks down and said, you guys are all taking equity financing. I don't care if you don't like being diluted, right? And it's going to ruin your stock price, but you're taking more capital. And Europe didn't do that. They were fighting between all the different nations trying to protect their banks from the most adjustment. Whereas the US said, you guys are going to take the pain now, take the dilution now. Your stock price is going to go down now, but you'll be able to reset sooner to come back and grow again. And this is part of the reason why the crisis in Europe dragged out for so much longer with worse growth outcomes. So we're very lucky. Our banks are well capitalized right now and well regulated. We're always watching the last. Generals are always vigilant about the last wars.
Thank God that was such a terrible war.
Yeah.
Maybe it's like peace in Europe for 70 years from now on.
Maybe.
But I'm just concerned about a lot of these assets are still very highly priced, but maybe the nominal value of a Bitcoin or a Tesla stock or an ARK share or whatever, maybe that doesn't matter at all.
Well, some of those assets won't matter too much, although I think Bitcoin, everybody's had a look at it by now, and no one is willing. Everyone kind of realizes it's a greater fool theory, and we've probably run out of fools because it was fine when the number was going up and risk appetite with people were looking for ways to make a lot of money quickly, and so they would close their eyes to these stupid stories about what Bitcoin did and didn't do, or would and wouldn't do in the future. But people aren't going to do that anymore. People are kind of seeing it for what it is. To be honest, all the altcoins and the NFTs were such a joke that it kind of exposed the whole thing, right? So I'm not saying new technology doesn't emerge somehow from these things or nothing good or whatever, but I don't think it's been worth the resources that we as economies have allocated to it. And I don't think it's anything that makes our lives any easier. I mean, the simple test is look at the people look around and you say, how does Bitcoin make their life easier? And I don't really know anybody who needs to do something that they need Bitcoin to do. They can usually do it cheaper and faster in some other way. So that's really that's never changed, right? That's never changed.
That's perfect. But I feel bad taking up so much of your time on a Friday. Thank you so much. This was incredibly insightful.
Good. I hope it helps.
Yeah, I bet a lot of people will be happy to hear something fairly optimistic.
Yeah, I mean, I don't want to call it too optimistic, but we got some stuff to slog through. But there are scenarios where it's going to be okay. What we don't know now is, how dramatically the slowdown is going to be. I am confident the Fed is going to be nimble. So when they see the slowdown start to hit hard, they're going to back off quickly. So that's good. But what we don't know, I mean, one of the consequences of having, global financialization over the past 30 years as a huge trend is, by financializing all these assets, by turning them into collateral and securities, securitization, and hypothecating them, et cetera, it makes the overall economy more sensitive to asset prices. And we don't know how strong that wealth effect, tends to increase the wealth effect from negative wealth impulses like the one we just had. And I just don't know how strong that's going to be, right? You know, does the level matter? I mean, a lot of people will have lost a lot of wealth, right?
Yeah.
Or is it enough that it just stops hurting, right? As it stops going down and starts going up or going sideways, that people will feel okay again. All right. So I just don't know which of those two things is going to be more powerful. And until we see that, we're not going to know whether or not we're going to get a recession or what kind of slowdown. And that's so there are concerns, obviously. But I think there are a lot of scenarios as well where we've seen in the markets the bulk of the pain, you know, and at least close to a medium-term bounce, if, you know, maybe more, but who knows?
Perfect. I'm just going to end the recording.